And so for each of those companies that we had in investments, we have calculated the required rates of return based on their betas. So this isn't the same as their expected return. So we should get different numbers here except for the Treasury bill rate. So the required return for high tech is 12.1. And then you can see what each of the other required returns are. So what we can do is if we've calculated those required returns, which is this column with the R, we can compare them to the expected returns, this column with the R hat. And then we can make a decision and say, is this stock overvalued, undervalued, or fairly valued? Now, the two that are going to be fairly valued are market and the Treasury bills, because they are both going to earn what we said they were going to earn. They don't have a beta. Now the high tech, you can see that the expected return is greater than the required return. And whenever that occurs, that means you're expecting to get more than actually is required. That's one way to think about it. And so it's an undervalued stock, and that means you should buy it because it should rise in value to go up to its true value. So undervalued stocks you always buy. Here it's kind of a close call, but the expected rate of return for U.S. Rubber Company is less than the required return of 9.9. And so in that case, when expected return is less than required return, the stock is overvalued. And you always want to avoid or sell or short sell overvalued stocks. And then we also see for collections, the expected return is less than what's required, so it's also overvalued, and you would want to avoid it. That's just so you don't experience losses as the market eventually works its way to the true price for the stock with the buy and sell pressure. And so we see kind of with those numbers, how do they plot along the security market line, which is also the CAPM equation. And you can see that with a beta of 1, if we go up to the line, that's where we get the market return if we go over to the y-axis of 10.5. The security market line, or the CAPM equation, crosses the y-axis at the risk-free rate, which is 5.5%. And then we can just look at the other companies. Collections and U.S. Rubber, they both are below the security market line. So whenever something plots below the security market line, those are overvalued stocks because their returns are less than what is required. And again, you want to avoid or sell or short sell those stocks. And then high tech was the one that was undervalued. It plots above the security market line, and that's one that has an expected return greater than the required return. And so it's a good buy. You should make a positive excess return on this stock because the market should bid this price up to be higher than when you purchased it. So let's look at what if we were trying to figure out the beta of a 2-stock portfolio, and we still have our same example with 50% in high tech and 50% in collections. Now for calculating the beta for a portfolio, it's really simple because it's just a weighted average. Take the percent invested in each stock times the beta and add them up. And then you get the beta for the portfolio. And so the beta for this portfolio is 0.225. And remember, the standard deviation was really low. And this beta is indicating a low risk portfolio. It's not going to move much relative to the market movement because the market, remember, has a standard deviation of about 20%. And this portfolio, if you remember, it has a standard deviation of about 3.4%. And so you can kind of see the beta being 0.22, how that compares. And then if you wanted to calculate what the expected return for the portfolio was, I believe we already did this, but, well, actually we did not do this yet. So If we had the two required rates of returns, we could calculate the required return on the portfolio before we had expected rates of returns, and so we got a different number. So just keep in mind, now we're talking about the required rate of return for the portfolio. So it's just a weighted average, 50% times the first required return for high tech plus 50% times the second required return for collections. And so we see what the required return for the portfolio is. Or another way is if you have the risk-free rate and the market risk premium, which we already determined were 5.5% and 5%, we can plug in the beta that we got for the portfolio and we get the same answer. So these are just two alternative ways to get the required return for a portfolio. So let's look at some things that could affect the security market line. And the first one is, what would happen if people expected inflation to increase, in this example, by 3%? How would that affect the security market line? Well, you can see the first example was the red line, and it's just a parallel shift upward. So if the risk-free rate is going to go up by 3%, 5.5 plus 3 is 8.5. And that's all that happens, is that all of the required rates of returns go up by 3%. So it's just kind of like, you think if inflation's increasing, then whatever that amount is, that's what you hope to earn as an increase in your total return. And then the other example is, what if investors' risk aversion, people became more scared? What if that increased by 3%? Then what would happen? Well, this is a different type of shift. It's just where the first line becomes more steep. So you've increased the slope by 3%. So it's not an across the board 3% extra for all of the different stocks for their required rates of returns. You would actually have to go through and calculate each one. For lower beta stocks, the effect would be less than for higher beta stocks. You can see that the required returns are higher. The effect gets larger. So when people get more risk averse, they're more worried about the market, and then that has a bigger effect on riskier stocks than on less risky stocks. So this is just a question that I guess researchers worry about, is how to verify the CAPM in a statistical way. And so nobody's really done this, but the main point is really that we all use it, and it's the best thing we have. There are a few other things, like you could add in the equation or the regression besides the market risk premium, but that's really for a more advanced finance class. So just keep that in mind. There's some extra factors you could add in a regression, but the market risk premium is pretty much the main component. And then there's also the consideration that maybe there should be some accounting for total risk, because not everyone's just concerned about how risky is my portfolio relative to the market, but how risky is my portfolio overall. So in that case, the security market would not produce a correct estimate of the required rate of return. However, we're kind of always doing the best that we can. The other concern is that when we calculate betas, which this is all of the big firms, Merrill Lynch, Edward Jones, any kind of big firm that's doing this type of estimate, they're all using historical data. But the only problem with the historical data is that it doesn't capture what people's future expectations are. But in a sense, this is the best we can do, but also this gives people, the CFA analysts, a job, because that every time they update their future beliefs, they can kind of make estimates for a new beta and figure out if a stock is undervalued or overvalued or undervalued. And that is the end of the Chapter 8 PowerPoint.